Bill, thank you so much for speaking to us. Now,
Pleasure to.
talk to us a little bit about the energy transition. With the war in Ukraine, is it going to take longer to achieve our goals?
That's one of the big questions right now. And obviously, on the one hand, the war in Ukraine has led to higher oil prices. And they were already on the way up on the back of economic growth. I think they were also already on the way up on the back of relative underinvestment in fossil fuels relative to demand. And of course, at one level, you say that's what we want. We want people to invest less in fossil fuels and more in alternatives. Now, with the price going up, that will just accelerate. That will accelerate the investment into renewables. It will probably also accelerate the investment into fossil fuels, though, because we will need to replace the missing production that either is or will be missing from Russia.
But Bill, did we properly plan for the transition, or are we missing too many of the components? And we're running out of cobalt. We're running out of some of the key components needed for the transition.
No, I don't think we properly planned for the transition, and I don't think that was really very front of mind for anybody. I think there was the thought that the transition will take time, that there will be a shift in investment away from traditional or fossil fuels in the case of greenhouse gas emissions, but commodities more broadly, that if prices go up, new investment will come in and will equilibrate, the way we always have in the past, maybe with some bumps along the way. I don't think anybody had a war factored in, and now obviously we're paying for it.
So what happens to energy prices here? So we're coming out of what, a decade of underinvestment in fossil fuel for the transition. We don't have supply from Russia in certain parts anymore. And so it's going to be what, like shock and inflation for the next 2 years?
Well, we've had a big shock, and I think when you get into $120, $125 oil, that's already a big move. I'm not a oil price forecaster, but could it go higher on the back of either further restrictions, further embargoes, or ongoing underinvestment? Yes, it definitely could. But I think inevitably some investment will end up going back into fossil fuels. However unappealing that is to people who would like to see a transition, exactly where you started the question. So I think that the markets will equilibrate over a period of time at a price probably a bit lower than where we are right now, because this is a demand-destroying price over a period of time. In the short term, though, we're very vulnerable.
What does it mean for your ESG investments? So there was a big appetite, and now people are worried about greenwashing.
Well, there's still a big appetite. I don't think the appetite
that hasn't been dented.
No. The appetite has not been dented. We'll see whether the money follows the appetite. Right? It's one thing to be hungry, it's another thing to buy the meal. And I think everybody, maybe not at this moment, but if you believe that, well, obviously we're getting higher interest rates. That's coming straight off the corporate bottom line. Although corporations are very well capitalized these days, their debt stocks are relatively low. And most have termed out their debt during this period of low interest rates. So probably less interest rate sensitivity. But of course, the interest rate increases are likely to flow through to lower economic activity, and that's going to put pressure on budgets. And the equity markets are calling for that. So are we really going to have the same investment going into transition activities that we had before? In terms of manufacturing process improvement, we have to think that the answer is no. In terms of investments in renewables, we have to think that the answer is yes, because that's actually become more attractive.
But money coming from where?
Corporate balance sheets. Okay. Corporate income statements. Yeah, I mean, that's the only source of money. Right? I mean, and you as consumers, we can chip a little bit in via carbon credits. But overwhelmingly, what the transition is corporations changing the way that they produce stuff or changing the way that they move stuff to emit less greenhouse gas. And that requires investment, and those investment dollars are going to be harder to come by unless it's economic, which would be the case if you're investing in an alternative power source.
But so given all of this, does the energy transition slow down until we've stabilized on energy prices, or does it stop and then accelerate all of a sudden?
So I'm an optimist, and I think, one, that the commitments that people have made, for the most part, are genuine. So all these net zero transition commitments that we've made and others, I think people actually intend to honor those. I don't think it's fluff. Two, the opportunity to invest in renewable power sources is only more compelling now. And that's three, I think there is an element of meeting a net zero transition, which is protecting the existing carbon sinks. And we get into the whole subject of carbon credits and are these good or bad.
What are they, good or bad?
Well, they're good. There's no question to my mind that they're good, but I know that there are opposing views. But let's agree on one thing: protecting the Amazon rainforest, protecting the Congo Delta, the Congo Basin, and protecting the rainforests in Indonesia. Those are good things. You know that in the Amazon we're emitting more CO2 these days than we're consuming. That's insane, right? And we're doing that because we're burning it. That's insane. So finding a way, a mechanism to protect those existing carbon sinks is critical. If we don't do that, the rest of the transition doesn't mean too much.
if we see a recession, I don't know whether that's your base, are we going to see a different allocation to capital away from ESG?
Yeah, I think, look, I got to think that the odds are that there's going to be a recession. I think this inflation is quite bad. It's intransigent. It's not transitory, and the consequence will be a recession. To me, there's a silver lining, which is that the financial system is strong.
Yeah.
And when you have a downturn in an economic cycle with a strong financial system, it tends not to be amplified. Okay. Weak financial system, it gets amplified, you get a financial crisis. I think it's very unlikely we'll have a financial crisis. So let's just say it's going to be a relatively shallow, maybe slightly prolonged recession, given the geopolitical uncertainties.
Prolonged, like a couple of years?
No.
Or?
I think
a couple of quarters.
A couple of quarters, yeah.
Okay.
And but we all know from previous recessions that when you're in the middle of it, it feels like it's the worst thing that's ever happened. Yeah. And a quarter or two afterwards, you're still wondering if you've actually come out of it. And so it feels like it's longer than it actually is when you look at the statistics. But if that's the scenario, then I think we will have some pressure on transition investments, but not dramatic, because I do think there will be a big focus on energy security and energy price alternatives.
Bill Winters, thank you so much.
My pleasure.